We have a lot of sayings and a lot of catchphrases we use, but this is one of my favorite ones. You don't need to get lucky, you just need to get old, right? So, you know, real estate's one of those get rich slow games, and I talk about luck a lot, and we had this whole conversation about it, and luck plays a big factor in a lot of this, and time plays a big factor in a lot of this. But we're gonna kind of talk about our journey a little bit and talk about using the VA loan. A lot of our group here is veterans, and some case studies in there, and we'll pick on some people in the crowd that maybe have done this already before. But we got some good stuff on the agenda today. Of course, like why real estate, right? Like, why is this such a great asset class to invest in? You know, it's one of the things we get asked about most, right? Go over some basics. I know there's some people in this audience that are a little bit more advanced than others, but we're going to cover some of the basics as if you know, you were a Marine or licking windows or eating crayons. Just kidding. I'm just kind of getting my ass kicked here. So we have a unique origin story with how we got into real estate and how we even met in general, which is kind of funny. But we'll talk a little bit about that and a little bit around our thesis and how we find properties and how we value things and what's important to us. And I think the biggest thing is, like, you know, for those that are just getting started, what are some of the things that we learned over the last 5, 10, 15 years now that could maybe save you guys tens of thousands of dollars or some headache? Because there's a lot of those lessons. But yeah, the things we wish we knew 5 to 10 years ago, I think that's might be some of the bigger takeaways from it. So let's go to the next slide. Oh, that's a lot of words. All right. Yeah. So just no, I know. So essentially, there are tiers to real estate, and
deck after, by the way.
Yeah, which you can squint your eyes even further looking at it. But you know, consider this kind of like this is not a linear path here. Some of this goes by size, but this is kind of just going over some of the different asset classes you can invest in, right? And typically when we break apart real estate, you have your 1 to 4 unit investments, right? So that's you could be a single family home, and then the 2 to 4 being your small multifamily. Whenever you get to 5+ units, you're talking, and you're in a commercial asset class, okay? And that could be mixed use, which we talk a little bit down below. But when we're talking about 5+ residential units, you're talking about you're getting a commercial loan, your commercial grade investment, okay? Different type of financing. Typically not as favorable as far as terms are concerned, from down payment to rate, but it's an interesting, that 5 to 50 unit, it's kind of our sweet spot. Too big for the small guys, too small for the big guys. We're kind of right in the middle. And so it's kind of like where we like to operate and play. You get into some of the bigger stuff, that 50 to 500+ unit. I have a lot of friends that are operating in these bigger apartment complexes. They kind of take on a life of their own little ecosystem. Not something, you don't see a lot of these type of properties around here. You get out to the burbs where there's a little bit more land, a little less density. You can find some of them. But you know, in Chicago, there's a plethora of the both 1 to 4 and the 5 to I'd say 15 or 5 to 14 is a very common you know, building structure in Chicago. And mixed use, when we talk about mixed use properties, we're like commercial on the first floor, retail on the first floor, apartments up above it. We own a couple of these properties. They're less common than your 2 to 4 units, your 5 to 14s, but they exist and they're great. And you know, we get to have restaurants in our buildings and smell pizza and cinnamon rolls and whatever they're making now at Lucky's Food Group. Yeah, everything. They literally make everything. So yeah, so the bottom here. Okay, so that's kind of like the groupings of properties. We also divide them up into classes, class A, B, C, and worse. So, you know, think of it as a grading scale, right? Your class A stuff's your really high-end luxury-esque apartments in your class A locations, right? The primo spots. your waterfront properties. Class B, kind of where we like to play, you know, the good quality neighborhoods, B minus, sometimes C plus. C, you start getting into like the really like a little bit grittier locations. We don't like to go any lower than that typically.
And tell people, especially if you're starting in 2 units or below, if you have VA loan eligibility, it can often be better to start with an FHA loan. Yes, you have to put 3.5% down, and yes, you have to pay PMI. In some ways, though, especially if you do have to pay the funding fee for the VA, it's slightly better to pay the VA funding fee from a math perspective, but the FHA using that first while you're eligible for it and it's easy is great, and then you kind of save the bullet for the VA loan potentially for future purchases. Not a guarantee, but it's worth considering. A VA shouldn't be the only thing you're considering when you're doing, even if you have the eligibility. Conventional, this is much more common to be 20% down. Conventional rates have inverted a little bit recently. They traditionally are better than they have been of late. And so right now FHA is about a half a point lower than conventional. Hasn't always been the case, and VA is about a quarter point below FHA. So that means VA is almost a full point better than conventional loans are. New within the last couple of years, conventionals you could put 5% down, which is really helpful, but you pay an arm and a leg in the PMI with conventional. It's even more expensive than FHA. And then there's some specialty loans. Any lender you work with should always be evaluating based on where you're buying and your income profile and a few other characteristics if you're eligible for some unique loan programs. So the first deal we ever bought was neither an FHA nor a conventional nor a VA. It was actually called a Home Possible, which is a derivative of a government-backed loan. And Home Possibles come with some really awesome terms. They have some automatic kind of government deductions, which buys down the rate. So we got within a quarter point of what the VA would have given us, with some really nice features the VA didn't have. And more importantly, it allowed us to do some things that the VA wasn't going to allow us to do that allowed us to close on the home. Won't get any of these details, but certainly for, if you're below the six-figure bracket, if you're buying in certain lower income tracks, which we were, they have other programs that are sometimes eligible. Chase has a big program like this. So these aren't the only products you may end up with. Next slide. All right, so specifically on the VA loan, you guys do not need to be able to read this. In fact, it's kind of purposely more dense than we'll cover in person. So everybody kind of knows, and we're not going to cover in depth here some of the benefits and like the terms around the VA loan, right? Like I want to talk about more of the why for the VA loan, right? And so I'm going to take a risk on some of the next slides and try to explain the financial mechanics of, like, let's call it a 30-year time period on why I'm such a huge believer in using the VA loan to buy multifamily, right? Because in the short term, it's actually relatively painful right now with where rates are to buy a 3-4 unit asset. But like the long-term benefit compared to like the next best thing you could do with your money, maybe being the S&P, which is the comparison I always use, is insanely better. And so we'll talk a little bit about that, the compound value you can get out of the loan. But I think it's worth pointing out some of the risks. So VA loans are inherently a poor product for short-term investors. So if you're going to buy something for sub 3 years, the VA loan is one of the worst decisions you can make. And the reason for that is because you're putting very little money down and you're taking risks over a short period of time where if the home were to decline in value, you could actually have some debts that you can't repay. VA loans are what's called negative leverage typically when people take them out, which means you're borrowing 100% of the price of the home, but you're also often rolling some of your fees into the loan, which means on day one, you owe the bank more than you could get when you sell the home. In some cases, a lot more,
especially
right?
With cost of selling.
Yeah, the cost of selling is around 6% of the value of the asset. So if you turn around and buy an asset and 2 years later you sell it, that asset needs to have increased in price about 8 or 9% in 2 years for you to break even. So VA loans are very bad investments for very short-term holds. And no investment's really, in my opinion, great for a short-term hold, with the exception of some like meaningful rehabs if you know what you're doing. But there's plenty of people in this room who could tell you what a bad idea that could be as well. And generally, they're not too risk-loving either. So their financing terms for doing rehabs are like, they exist. A lot of lenders won't do rehab loans, and they're not going to give you a lot of money to do them. You have to get an exception to get more than $100,000 to rehab a VA loan. So it's just not a great product if you're looking for flips or if you're looking for deeper rehabs beyond, like, let's call it a lipstick, which includes plumbing, electrical, etc. A couple kind of unique awareness items too is, like, obviously, like, it's pretty important, in my opinion, to work with a realtor. This is, as a lender, like, is it impossible to work with a realtor who doesn't know VA loans? No, but like, dude, you're in interesting shape. It's not like the deals aren't going to close, but if both realtors have never done a VA loan before, it's going to be harder. And so I always say there's three people in every equation for a loan, right? Or for a deal. There's the buying realtor, there's the selling realtor, and there's the lender, right? Like, at least one of them needs to know what they're doing with a VA loan, right? The second thing is, at least one of them needs to know what they're doing, fucking period, right? Like, a transaction can close with just one of those three parties being savvy.
Somewhat common.
But if two of the three or three of the three are not savvy, and there is a difference, like, you will close far less often than you don't. And I have a client falling out of contract right now, and the realtor is excellent. I can't speak for myself, but the selling agent is atrocious. Like, basically just, we had to report them to the state. That's very rare. And like, he's losing $4,000 in costs that he had to inspect, to get an appraisal, to do a bunch of things to this home, and he's not even going to close on the home. So, and most of that was due to just, like, you can't control your selling agents, right, to a degree, but it's pretty important, especially with these more nuanced products, VA especially, to have someone in the deal who knows what they're all about, especially because the selling agent often does not know. And so it's kind of the buying agent's job, and to a degree my job as well, to give them comfort and to sell them on why the VA loan's not going to be a problem. We do this all the time.
One of the big things is the appraisal process, right? So it differs a little bit from your normal conventional appraisal, similar to FHA, but the appraiser is going to look for safety hazards in a building, right? So, which they don't typically do on conventional loans, but they're going to look for missing handrails. They love chip paint for whatever reason. They love it, so they love flagging it. Whenever I'm looking through a building, like, and I know the buyer is going to be a VA buyer, I'm looking for these things, right? And I'll tell you right off the bat whether this is going to be problematic because those issues have to be settled before you close. There's no holdback of money. There's no, those need to be fixed before close. If the seller's not willing to do it, you might have a dead deal, right? And a lot of the other agents don't understand this, right? So I try to educate the other side and say, hey, look, if there's issues, we need to come to the table and solve them. I've freaking scraped and painted entire basements before. I had to paint my deck in my house in order to refi with a VA loan in the middle of winter. Like, it had snow on it, and because the deck had chip paint. So these things do come up. It all depends on the appraiser that you get. It doesn't mean to scare you guys, but these are just some hurdles that you have to work through, and it's why it's important to work with somebody that knows, what they're looking at. So, yeah, it's a big thing that I try to at least take away from all the tours. Will this thing be a problem for the VA loan? So,
I think this advice works in reverse too. Like, when somebody comes to me and they want to do a loan I've never fucked with before and hope to never fuck with again, I just turn them away. And a good example of that's like USDA. They're not common in Chicago, but they're actually quite common. And like, my sister lives in Vermont, and like 30% of the loans in her area are USDA. Like, I won't help my sister with a USDA loan because, like, I'm literally not the best person to do that. So this can work in both directions. And I would argue similar for, like, no offense, Andrew, but I would not hire you probably to buy a luxury condo downtown. People have, and it's not the end of the world, but like, there are better realtors for luxury condos. There are better lenders for different loan types. Next.
well,
Andrew.
Yeah. All right. We're going to get to more of the things 10 years in the past.
Thanks, pal. Thank you. But this is just a couple of key takeaways from the get-go. You can read all the books in the world, right? And the only real teacher in any of this is going to be doing, right? And so I'm a ready, fire, aim kind of guy, and I make a lot of mistakes. And hopefully we could continue this conversation outside here and help kind of learn from some of those. But you're really not going to unless you get out and do it. Unless you get out and start touring properties and buying properties, you end up on the sideline longer. If you try to overanalyze these things. So the best teacher is experience in this for sure, hands down. No one's going to get anywhere of any scale in real estate without using debt, right? Like, eventually you run out of your own money, always. Like, it's impossible to, yeah, I mean, we all know this all too well. Tony knows this all too well. Unless you have that unlimited pile of gold, you're going to run out of your own capital, and so leveraging debt in a smart way, right, is important here. Responsible debt usage. Another thing I talk about a lot, you don't have to start small. There's no linear path in this, right? I say this all the time, but buying a 5-unit commercial property is easier than buying a 2-flat. I'll tell you that all day long. Now, some banks won't lend to you because you don't have any experience, or because you've never done it before, or you might not have the right balance sheet. But by and large, the process of buying a 5-unit and above is easier than buying a 2 to 4 unit. So you don't have to follow this traditional path. Let me buy a single family home, let me buy a 2-flat, then a 3-flat, and then gradually work up there. You get a little experience under your belt. It doesn't hurt to try to go a little bit deeper, a little bit larger with some of the stuff. And anyone that tells you that, like, oh yeah, real estate's passive, I get this mailbox money, they're full of shit, right? It's not passive. If you are actively engaging in real estate, it is a contact sport. You need a team around you. You need people that know what they're doing. Kyle will tell you, like, we are in constant battles on a daily basis. It takes a lot of work. If you want to bury your head in the sand and put your money blindly at something, throw in an index fund. Even if you're passing it off to a property manager, there is work to be done, and it's definitely not passive by any stretch of the imagination. So, all right, let's go next slide. Yeah. So there's a lot of rewards, right? There's a lot of ways you make money in real estate. And residual passive income. We just said it's not a passive sport, but the idea is to buy assets that are generating you cash flow every month. Sometimes they don't. Sometimes they start off where you have to infuse them with capital. You have to fix some things up. You have to get rents up. Let inflation and time kind of do their thing. But over time, these assets start performing where they're paying you while you sleep. It's a get-rich-slow game, though, like I've talked about. Of course, price appreciation. So, we love to let inflation and time do their thing and drive rents up, and also while you're paying down your debt, right? And so that gap of equity spread, that's where you're making a nice chunk of money when it comes time to either cash out, refi, or sell, or whatever your exit strategy is. We could spend a whole lesson on tax benefits. I'm no CPA, but this is probably the most appealing piece of investing in real estate. There are a lot of people that are going to tell you some wrong information about taxes, but one of the key things that we do in this game is we're making cash flow, but at the end of the day, we're not paying any taxes on it. Okay, and so the tax code was literally written to benefit real estate and small business owners, right? And so it's a good use of your money from that standpoint of being able to make kind of tax-free returns. And then as you get a little deeper into this, there's a lot more. There's like some PhD level type of thinking. It's probably not PhD level thinking, but it's, for my head it is. But you get into some more work with 1031 exchanges where you're deferring taxes down the road. There's a lot of things with passing these things on to thinking about passing things on to after you die. With the legacy, we like to hold things forever. So there's a lot of thought that goes into some of these things, but not just from an income tax return standpoint, but as veterans, we get a lot of tax benefits, right? So if you have a disability rating above 70%, you're most of the time going to be exempt from taxes for single family homes. Multifamily, it gets a little bit fuzzy. I think it depends on if
the law says you should not get an exemption for your entire property. The assessor often misses it and gives you an exemption for your
correct. Yeah.
But you should not assume that is going to happen.
So if you own a 2-unit property and you live in 1 unit and you're, let's say, 100% disability rating, the livable space that you live in should be tax exempt. So you should technically get a 50% off of your taxes. Same with a 4-unit, you should get 25% off. However, as JD said, sometimes the tax assessor doesn't realize it's a 4-unit.
Not a form that I'm aware of.
Yeah.
I've done this myself numerous times. They're supposed to be asking you when you fill it out. They're supposed to realize based on the PIN that it's a multi and have you fill out a square footage equation, and they just don't seem to be doing it.
Yep.
It's a little weird. I wouldn't count on it for everything.
And diversification, right? Like nobody wants to put all their eggs in one basket. So a lot of my eggs are in real estate, which is great. But within real estate, there's a lot of ways you could diversify, whether it's location diversity, whether it's asset type or investment type, short-term rentals versus long-term rentals. There's a lot of things you can get into, but this is a good kind of way to augment your traditional 401k investing or your traditional index fund investing or stock investing, just to add another source of or another place to throw your money for long-term investment.
I think it's worth noting that almost everybody I know who owns commercial property or even 4 units and above, typically had a pretty good amount of money in a 401k or an IRA before they started. For a couple of reasons. One, a lot of people don't get into this until a little later in life, late 20s, early 30s at the soonest, typically. And 2, banks really don't like it until you have some savings. And so when you get to the commercial level, if you can't send them some IRA and some 401k statements showing some, it's not really very liquid, but they still call it liquidity in some cases. You can't show them some assets. It's a little harder to get started in the commercial space. It doesn't matter for the purposes of this conversation on 4 units.
And one other thing I'll mention on the tax benefit side, it's not really tax, but you can invest in real estate through your IRAs. So a lot of people don't know this, but and this is kind of like an area that I'm not great at, but there's a lot of other people that are. But you could do what's called a self-directed IRA and put money into real estate. A lot of rules. You got to follow the rules. It's not for the brand new beginner, but there are ways to do that, and you can kind of compound some of those growth with even further tax savings. So, all right, this has got some numbers and charts and stuff. So this is JD's arena.
There's almost no way this is going to be useful, but all right. You guys might need to come around a little. I don't know why I thought the screen was going to be bigger, but so all right. I'll cover the high levels here. So Andrew talked about a few of the ways that you predominantly make money in real estate. And I'm just going to address with these charts, and you guys can look at this a little more closely when we send them out. So you'll have to bear with me. And Kyle, you have to bear with me. We'll toggle back and forth between them a couple times. But the headliner here is I get the question a lot, even from pretty savvy, some of my classmates from business school would be like, why would I ever invest in an asset class that returns 2 to 4%, right? It's a good question, and it's kind of my life's mission to prove to people how the responsible usage of debt does what's called levers up your returns. And so, Andrew talked about not all debt is bad debt, right? We're not Dave Ramsey. We're not talking about credit card debt at an average of 30+% interest at this point. We're talking about responsible usage of debt in order to use the bank's money to make money, right? And there's 3 ways you can do that. So what I'm showing here is the top 2 charts there are left and right comparisons, right? And so on the top left side, the 20% down payment, that's the 3 different forms of money you make on an asset. The blue is your cash flow. And a key assumption in this is that any cash flow you make in this model gets reinvested into the S&P for lack of harder calculations like rolling this. We take all the money we make on properties and roll them in other properties, right? So instead of making 10% in the S&P, we make 15. And over time, that 15 is not just making you 5% more, right? It's making you 50% more compounded over many years. So the blue is the cash flow. You notice, you actually can't notice because these charts suck, but actually for the first 5 years of this model, the cash flow is negative on the 10% down, and especially on the 0% down, which is on a future slide. So you're actually starting out with frankly, in this model, the 0% that we'll talk about, the 0% down, you're putting $30,000 down to buy an asset. That's your closing cost, right? You're actually losing another 25 grand in the model, the way I've drawn it out. In the first few years you're operating, you're not losing money, but it's more like you're spending money out of pocket to repair things. You might have to cover some rents and months of vacancy, et cetera, right? So the blue takes a while to get going, especially at the 10% and 0% down levels. The red is your debt pay down. This is like my favorite part. So I did the math on this. So if, let's say you just buy a $1 million floor flat. Most floor flats in Chicago cost about $1 million bucks. It's a pretty easy example, right? You put in about 30 grand down. You know, if Andrew's your realtor, you're getting 20 grand back somehow. But like, he likes credits. He likes credits a lot. It's a huge pain in my butt. But like, let's say you put 30,000 down. Maybe your realtor doesn't know to get you credits. Maybe there's not an opportunity. You bought well. You can't find anything wrong with the place. You're not getting credits. Put $30,000 down. That's generally your closing costs, right? That assumes you roll your funding fee if you have one into the loan. So, right? If you just fucking white knuckle that investment for the next 30 years, right? If you just hold on tight and do what you got to do to keep that building full and to keep it standing, right? It doesn't change in value at all. It doesn't cash flow you a single dollar, right? You just beat the S&P by 30%. And not by 30% total, by 30% every single year. So the IRR of that investment is 13%. That the historical IRR of the S&P, including dividends, is 10.9, right? And so if you literally just buy a building, never cash flow, which would be pretty embarrassing after 30 years if you can't cash flow, right? That's not including the fact that after 30 years, you better be cash flowing because you paid your loan off. But if you just literally never cash flow, which means you buy it and you never raise rents, and you probably don't take care of everything you're supposed to, and some stuff breaks all the time, right? Like if you just do literally the bare minimum, you will have made a 12% return. There is no other asset, like there is no other lending product out there. There is no other investment you can make and not get lucky. So like for context, a lot of these other return scenarios that I'm showing here are like more like 15, 17% IRRs, right? Anybody here can name me the 2 investors that have ever beat the S&P for more than 20 years in a row at a 50, except for that weird like tech guy. I don't know who. Warren Buffett's one. Staying out of politics, Ray. The other one's Peter Lynch, right? And then there's actually that other guy who uses like quant trading, who's actually crushed both of those 2 guys. No, not Dalio. He's like a secretive guy. He like capped his fund at like $1 billion, and like part of the reason he could do that is because he never got too big. But anyways, like it's pretty insane. So if you're making a 13% return and someone else is making 10, that 3% doesn't sound like much, right? But that's literally every year you're making 30% more than that other return. And when you compound that over 30 years, that can like 2 or 3x your return, right? And so that's just paying off the note, right? If you actually make cash flow, which you can see a huge percentage of this is actually the blue at the bottom, like 2/3, 3/4 of your return is typically going to be cash flow on these things, but not at the beginning, right? The red, that's the part I'm talking about, is the debt pay down. And then yellow, which is like what a lot of people think about when they think about making money in real estate, is your value growth, right? So like if you buy a property for $1 million, in 30 years, what do you guys think that property would be worth?
1.5.
No. Using just typical Chicago growth rates.
In how long?
30 years.
30 years.
Yeah, it's going to be over $2 million. And that assumes like 2%, right? 2.25%. If you go to Kyle, so okay, headline, actually stay on that slide real quick. Headline of that is like on the right side, if you just put 10% down, you can increase your return versus the S&P by like a factor of 50 or 70%, right? Like end of day after 30 years, you're like 50% better off. Probably the headline on the 20% down though, and this wasn't always true. When I used to show this chart and rates were 3.5%, like real estate just destroyed, right? Because like, the return that real estate give hasn't changed as much as interest rates have. That's why it's made it a harder game. But real estate used to just destroy every one of these charts. But actually, when you have to put 20% down, if your value only grows at 2%, you use some of these really aggressive assumptions on costs that I used, you're actually barely catching the S&P, right, with a 20% down investment. It's actually why a lot of people are on the sidelines right now. Now let's go to the next slide, Kyle. These are the exact same slides, but it's just adjusted for like if real estate grew at 3%, right? This is about Chicago's historic average. Neighborhoods like this are actually a good deal higher in the last 30 years, but I wouldn't assume that's going to continue to be true, right? California grows at more like a 4 or 5% clip. A lot of that is fake because they don't charge what they should for insurance and they don't charge what they should for taxes. And it's also highly sought after. So, it is going to change. It's already changing. But if you just assume property grows at 3%, which is more than normal 40-year average in Chicago, right? You beat the S&P all day, right? At 10% down, the one on the bottom, you're at like just under 6 million by the end, and you're at under 4 million, right, for an S&P investment, which means if you're buying $1 million place and you had $100,000, right, and if you were either going to put 10% down to buy a place, you would end up with those assumptions at just shy of 6 million, right, which assumes you reinvest your cash flow, or if you just left it in the S&P, you would have about three and a half or so. So that's like pretty mind-blowing. That's the power of leverage, right? Like, how did you turn an asset that only grows at 3%, and how did you catch something that makes 10.9%? Well, you caught it because you're 10% down, your 100 grand makes 3%, right? But the banks, right, 900,000 is also making you 3%. And they gave you 9 times more money than you put in, right? So you're making all that percentage from the bank on top of what you made on the money you put in. So that's how 3 turns into 12, turns into 15, turns into 20. Does that kind of make sense? I'll pause here and see if that's generally jiving. I still have to figure out how to explain this.
One thing I'll point out. Is like, this is like the start of the snowball, right? The theory of the snowball is like, okay, you just need a steep hill and some wet snow, and it picks up some gravity and goes down and gets bigger and bigger and bigger. You look at my first property I bought, which we're gonna talk about in here in a minute, but that one single purchase over the last 18 years has enabled me to buy almost everything that I bought thereafter, right? One cash out refi for $100,000, bought an 11 unit, and selling that bought me everything else, you know, like, so it's you get one of these and it has the potential to 10, 20, 30x just for being in the game, right? Putting very little down to start. So that's the other impact of all this, but just you got to get in the game. So.
Yeah, and we're never, like, I'm not here to sell you guys on a dream, right? We're not freaking Grant Cardone, right? Trying to convince you guys to invest in a building every year. Yeah. Like, we're not trying to tell you that you should be like snowballing every deal into another deal. Like, literally at the root, right? Like, if you just buy one building and you don't fuck it up too hard, like, you're going to fuck it up, but you don't fuck it up too bad. You just white knuckle it and you hold on to that building. That's kind of the scenario we're looking at here, right? And then if you do it well, you start adding some reds and some yellows into it. Right? Really, you get the red and yellow no matter what if you hold on to it. You start adding some of the blue, which is really the base that creates the really long-term returns. And then the crazy one is like what we're talking about here. So next slide, Kyle. And that's like that's a 0% down. So right, the 20% is your down payment versus the S&P. So the same top 2 charts you've seen before. The VA loan is the 0% down, right? Assumes 3% of closing costs. If you took that 3% of closing costs and held it for 35 years, you'd have quite a bit of money, actually just shy of $1 million, right? If you took that same $30,000, you have less than you had in the 20%, 10% down scenario, right? Because you put more money into the deal, you get more cash flow from that. You saved interest, so that savings and interest kind of compounds for you too. But the VA loan ends up still pretty competitive, $3 million. But more importantly, right, that $3 million you get, well, you only put 30 in. Let's say you had 100, you had 200. Let's say you had the 200, like the top scenario, right? You could get both. And what I mean by that is you could have taken the 170,000 and got the money in the top right chart, which is damn near $6 million at this point, right? And you could have taken the 30,000 and had the 3 million. So you took 200,000 and you turn it into $9 million, right? And all this seems like hard to believe. I still don't fully wrap my head around compound interest, right? But like Einstein, by the way, also didn't wrap his head around compound interest. But like literally you can compare to a normal investor who's going to buy that same 4-unit property and they have to put 200 grand down. At the end of time, they're going to have like $5.5 million. You are going to have 9. Because you used kind of that leverage and that power of it, and you snowballed your returns into like other yielding assets, in this assumption S&P, and you got the same benefits they had because you didn't spend the 200K at the top right, and you add that to the value that the 4 flat created for you at the end of that 35 years. None of this shit kicks in though for like 5 to 7 years. Like the first 5 years sucks. Like our first 4 years after we bought our first place, we didn't buy another one. And then finally, like with some help of some other people and Andrew, we bought another one. But then like years 4, 5, and 6 were revelatory. Like we got hit with some taxes eventually that hurt for the last couple of years. But like our first deal, our 4-unit, and we're much more recent investors than Andrew, Joey, and I, who's not here yet. Oh shit, Joey, what's up, man? So Joey and I partnered first, and then we joined up with Andrew. But like, I don't know, Joey, from like 19 to 22, almost every investment you and I did together came from the same 4-unit building. Yeah, like we invested in a private equity fund, we invested in a couple venture capital funds. We've probably lost all that money by now, if I'm being honest, but like we treated it as if it was burned anyways. But like this property just kept cutting us checks, right? And it's just, we didn't do anything fancy, we managed it well. Now granted, that happened faster for us because we have some really great interest rate debt on these properties. So it's what took us 3 or 4 years might take somebody else 5 to 7 at this point, right?
That being said, that sucked when we bought, right? Like, yeah, we got lucky, but if you didn't have a property to refinance, like, you don't have tickets to the lottery.
Yeah.
You know?
And also, it was way harder to buy a property when we bought, which we'll get into. So anyways, hopefully that all makes sense. Joey, I'm curious for feedback later. I don't have any idea if I did a good job explaining that, but next slide I think is, and I'll just take this one, Andrew, but like, I'll breeze through this because we're running out of time. I want to talk through a couple of the case studies, but like, I think this is our strategy. You could read through it later, but like, we don't sell. We know way more poor flippers than we know poor buy and holders, so we chose to be the buy and holders. We also just plan to leave our assets to our kids. When you leave your assets to your kids, like, they don't pay taxes like you would if you sold it before you died. And then, you know, assuming Trump and others don't change that. And then we started with max leverage, but we are not there now. We won't buy anything zero down anymore. Not only would a bank not allow us, but like, we're not at the stage in our lives where we need to do that or want to do that anymore. This is kind of like something you shouldn't, in our opinions, be seeking to do with every investment. Like some of the gurus will recommend. Eventually, zero leverage catches up to you, or 100% leverage catches up to you. So using the VA loan is a great benefit, but it's not how you should anticipate doing all of your deals. All right, Kyle. Joe, you want to talk through this one? You want a speaking part here?
Not really.
Okay. All right. So this is what Airbnb photos used to look like. Joey and I got the Airbnb bug in like 2014. We did 50 tours before we saw this. So Andrew, thank God you weren't our realtor. Poor Redfin. The deal ended up falling through, so we didn't get a VA loan on this. So we had to use that Home Possible we talked about earlier. We sweat a couple hundred hours into this building, full disclosure. Like, running Airbnbs is at least a factor of 5 times harder than running long-term rentals are, maybe 10. And we basically took a $125,000 seller's note when we bought this. Don't recommend that in general. That should not be a strategy. It was a solution to a problem, not part of the strategy. And we paid that 125 grand back in a couple years, about 18 months, Joey, using cash flow from the Airbnb. So basically we bought ourselves jobs, which worked out pretty well. It was definitely a golden era for Airbnb. It was before everyone was doing it. We now owe about $820, $830 on this building. That's after like one cash out refi we've already done and a couple other subsequent refis to get the rate kind of well below 3%. And we say it's worth at least 1.1. I would not sell this building for anything shy of like 1.2, 1.3 at this point. And it's pretty ugly. You can see that green fireplace. That's probably its nicest feature.
Doesn't work.
Yeah, actually, when we bought this building, it almost blew up a week into owning it because the entire inside of all of the walls in the front building were coated in gas because there was a quarter-sized hole in one of the gas pipes just running into the walls. And a tenant who'd been smelling it for 2 years chose not to tell anyone. So we were negative $3 grand in the hole fixing that issue on week 1. But the moral of the story was like, this is probably a good example of like, we really couldn't get anyone to take our offers, so it was a different problem we had back then. No one wanted a VA loan, and we were overpaying for sure, but at the same time, once we finally landed one, we had this amazing interest rate. And then the other moral of the story was just kind of the luck thing Andrew talked to. Like, this deal kind of inadvertently led to meeting Andrew because we were now interested in real estate. It also inadvertently, the guy who sold us this building is now our largest investor. And he owns like over a third of all the real estate we buy, which was pretty awesome. Basically, we paid him back fast, and we were like, hey, you can put that money in your checking account, or you can buy another building with us. And that's when Andrew joined up, and that's kind of how everything worked out. Andrew, you want to talk through the next couple?
I think Joey's deal is the next one. Go to the next slide. So I can't take a lot of credit. This is actually the ugliest building I've ever seen in my entire life. But we had a free mural done on it a few years ago, yes, now it's even uglier.
Pretty nice.
Yeah, it's nice inside, but thank you. So this is one of my top 2 case studies for like using a VA loan to buy a building. So client of mine, good friend, good looking guy, uses VA loan to buy a 4 flat. It was $1 million. This is 2021. Long story short, came out of pocket, I think $12,000 total at the end of the day after all was said and done. Now, granted, interest rate environment was a little different then than it is now, but this property cash flowed on day one. I will tell you this, there are a total of 0 properties that'll cash flow with 0% down unless you're in the hoodiest of hood places, and you're probably going to need to put a lot of work into it. But there are not any places that'll cash flow on day one with 0% down loans. But this one just happened to, just because of the timing. I think the interest rate was like 2.75 or something ridiculously silly, but this is the power of the VA loan. This thing is going to continue to increase in rent over the next 30 plus years that he owns it. We are managing it internally within our company, so it's for the owner. It's very very low hassle. The same tenants, I believe, that we placed. Some of them were already there when we bought it, or when our client bought it. But I think we placed 1 or 2 more after that, and they've been there since 2021. So very little turnover on this thing. But this is like a pretty standard, West Town 4 flat. They're a little bit more money now than they were then, just 3-4 years ago. But name me an asset where you could buy $1 million building, or name me a loan type where you could buy $1 million building with $0 or $12,000 out of pocket, and turn into this thing. But cash flow is $18K a year after management, taxes, repairs, all your normal expenses. So this is a great building, and just what looked like a base hit at the beginning, but this is going to end up turning into something much bigger for the owner. Let's see. This is a classic ugly building deal for BCG. Yeah, we don't we have some gray stones in our portfolio that get JD really, really excited. This was not one of them. It's actually 2 separate buildings, and they're as plain Jane as they come. But sometimes it's and we'll see another dumpy property on the next slide. But sometimes it's the simple ones that just actually outperform everything else. So.
Frankly, most of the time.
Yeah. Let's go to the next slide. All right, so this was my first property. I bought it in 2008. It's literally this 4-unit. So no, yeah, it looks like Iraq. It's El Paso, Texas.
So it is Iraq.
Yeah.
El Paso, depressing.
Yeah, there's literally.
I only laugh because that's where I met you.
Yeah, exactly. So. This is like as plain Jane of investments as they come, but I paid $192,000 for this thing. I did not use my VA loan on this. I didn't know what a VA loan was. I thought I thought it literally was a personal loan that the bank was even given to me, guaranteed by the government. I had no idea. So I read a couple books and I was like, I'm going to just buy a 4 flat, and I did. And that's why I tell you, experience is the best teacher, because I made so many mistakes on this thing over the years, but I still own it. Okay, and now I've refinanced this thing I think 3 times. I have a 3.25% 30-year debt on this thing, and I probably make $1,500 a month of cash flow, and I don't lift a finger. I do the taxes at the end of the year, and I have a guy manage it down there, and. This is the snowball. This is the base hit that turned into a home run, because my first refi in 2013 pulled out $100,000 in equity, bought an 11-unit building. I refinanced again in 2017, dropped the rate, pulled out another 50, 60K in it. It's now worth like $350, $400. Rents are $3,600 a month, I think now. So yeah, this is the gift that keeps on giving. I've owned it for 17 years though now, right? So nothing special about it. It's probably looks the same as every building on the street there, but it's a box. It's 4 squares next to each other. Low vacancy. Literally one of the tenants has been there since I placed them in 2009. So people stay, and this is in kind of an interesting location where there's a lot of tenants, and a transient workforce, a big transient workforce with the military, border patrol, all that stuff. So you always have people that are looking to rent and not set roots down. So, but this is one of those great examples of start the snowball down a hill, and yeah, it just turned into a home run for me. So, had I not gotten to the game, and like, oh, by the way, like the financial world was collapsing around me at the time, and I had no idea, right? I was 22 years old, and I was like, oh yeah, I'm going to buy real estate. I literally like read Foreclosures for Dummies. I never bought a foreclosure even after that, but that was like my extent of bigger pockets didn't exist. None of this stuff was around to help, and I kind of just jumped head first. And even despite, we had to replace the roof within the first 6 months. There's cockroaches in this thing. There's a lot of stuff that went wrong, and it turned out to be still the best investment I've ever made in my entire life. So, all right, next slide. We talked about some of these things already, but this will be, I think, our last big slide, and I'll share the limelight a little bit with JD. But we talked about bigger deals are sometimes easier than the smaller ones. From a lending perspective, it's not. Sometimes it's always. I'll say that. We leverage other people's money all the time now. You're going to run out of your own cash at some point in time if you want to scale and grow this. So leverage your network. You'd be amazed at how many people that you know want to get exposure to real estate but have no idea how to, or don't have the time or effort or some element that make up a deal to get into it, right? So if you want to grow past your point of your first or second or third, you're going to eventually need to borrow some money from other people. We like to take care of our buildings, right? Go figure. You have nice buildings and you treat your tenants well, that you're going to have better returns on your investment. It shouldn't be a surprise, but some companies don't think that. One thing that we found over the years that we've always everything costs more than we thought it was going to cost, right? And typically maintenance, right? We always say, oh yeah, $75 per door per month. Sure, that's a good metric. I would always plan for $100 or $120 just to be conservative, because your cash flow numbers are always going to look better on your initial model than they typically end up. And especially when you get investors involved in the deal, you always want to under-promise and over-deliver, right? At least that's what we like to do. So I would say just be conservative in any estimates you put on, and don't believe anything that realtors put on the MLS as far as expense data is concerned, because it's not real most of the time anyway. Let's see, managing your life. All right, so I'll skip some of these things, but I talk about luck a lot and time in the market, right? And I think it goes without saying that, like, I wouldn't have gotten to the point where I'm at now without a shit ton of luck. I was born in 1985, right? So I'm in my prime earning years, right when we had the lowest interest rate bull market combination of history ever, right? We had 10 plus years of a crazy fucking bull run, and I wrote it, right? And I wrote it as hard as I could, and I wish I did more, right? I wish every property that I thought was too expensive back in 2013 and 2014 when I was looking, Logan Square here, right? I said, shit, I'm not paying $450 for a 3 flat. What are they, crazy? So yeah, right, minimum. So all this to be said is, like, get in the game. The more time you have in the market, to be able to get lucky, you got to put yourself in a position to get lucky in order to get lucky, right? So that's my biggest piece of advice there. And then everything takes longer than you think, right? You're going to map out your course. Okay, I'm going to buy a property this year, then 2 next year, then 3 next year. Tony knows this, right? Everything takes, well, Tony's the exception. Tony's like, I'm going to buy 8 things this year, and it's like, that doesn't make any sense, and you're over. You're thinking way too hard, but Tony always makes it happen. So he's good like that. But for most people, everything takes longer than you think it does. So if you want to scale, you want to grow in real estate, like, it's going to take. It's not a get rich quick game, that's for sure. So JD, anything to add here? Things you wish you knew 10, 15 years ago? I would have bought more. That's the only thing I'd say. Yeah.
I would have never bought less than a 4-unit property with my VA loans. Like, we had a slamming duplex. None of you guys will beat this duplex Joey and I bought together on a VA loan that my wife had, and I still regret it because like a shitty 4-flat would have been better than a slamming duplex. That's one thing I think we've learned in the last 3 years really is like asset prices as the number of units in a building come down. So like the price per unit that you pay for the same unit in a 6-unit building is actually upwards of 20% plus less per unit than in a 2-unit building. Maybe even like 30 or 40% less than probably, I don't know, Andrew, maybe 50% less. I mean, we buy doors in this neighborhood for under 200K, and I don't think you guys are going to find any duplexes in this neighborhood for less than 600. So, you know, I probably would have just started at 4 and never gone below it. And that's what I call maxing your VA catchphrase there. But I also think I would have, we would have like ideally moved to commercial faster and never messed with residential loans with investors. It's too complicated. You have to like play in too much gray. If we were going to take money, we should have gone straight to commercial to do it.
Joey, probably the wisest one of the group here. Anything you want to add? Is this mine or is this yours? This is mine. Okay.
I think you got it all. There's a lot of wisdom there, man. How can I top that?
And I glossed over this, but leverage the magnitude of information available to you, right? Like you have more resources available to you now than we did in 2008 when I was reading foreclosures for dummies, right? Literally every problem that you're going to run into has been solved before. And if you can't find it on the internet, you surround yourself with people that are smarter than you. And like that's what I've done my whole life because, I mean, look at me. Not very smart. So that's kind of what I'd add here. But what questions you guys have?